The United States is defying predictions of a 2023 recession. We think a recession is likely, but it may not happen until 2024. Inflation is falling only slowly, and central banks have still not finished tightening. We're positive on government bonds, but the outlook for equities is less clear-cut. A resilient economy and the enthusiasm that is boosting stocks linked to artificial intelligence can support the equity market in the near term, but longer-term headwinds are building. Hi, I'm Andrew Pease, and I'm the Global Head of Investment Strategy for Russell Investments. Welcome to the third quarter update of our 2023 Global Market Outlook. There's a character in Ernest Hemingway's The Sun Also Rises who is asked how he went bankrupt. He answers two ways: gradually, then suddenly. I think this is a good description of our outlook for the US economy. Forward-looking indicators such as the inverted yield curve, tighter bank lending standards, weak manufacturing activity and depressed consumer confidence are flashing warning signs. Meanwhile, measures of current economic activity such as jobs growth and household spending are only gradually moderating. Most of the other economies are also slowing and at risk from aggressive central bank tightening. Growth in the Eurozone is buckling under a steep decline in bank lending, and persistent inflation is forcing the Bank of England to tighten further despite the lack of economic growth in the United Kingdom. China's growth impulse is faltering following the post-lockdown surge. Japan remains an outlier, where monetary policy is still ultra-accommodative and GDP growth is likely to remain above trend. The creeping slowdown in the United States seems likely to persist for a few more months. The forces driving the slowdown are being offset by the fact that households still have around about $500 billion in excess savings built up during the pandemic, corporate profits are stabilising, and housing market indicators are picking up from low levels. The 500 basis points of Fed tightening since last year is starting to bite. We can see it most clearly in the regional bank collapses earlier this year, in tighter bank lending standards, and in rising delinquency rates for credit cards and automobile loans. But the uneven economic data and still high inflation means that a further Fed rate hike cannot be ruled out. We think that the amount of tightening so far is enough to bring inflation back to target and significantly slow the economy. Further Fed tightening, in our view, increases the risk of recession. A recession in the United States seems likely over the next 12 to 18 months. The tipping point will probably be a renewed decline in profits that forces firms into austerity measures such as layoffs and cutting back on capital expenditure. Households, after they have exhausted pandemic savings, are likely to respond by cutting back on discretionary spending. The market consensus expects the recession to start by the end of 2023. This is possible, but we suspect that it may not start until sometime in 2024. A later recession should be a milder recession for the simple fact that by 2024, inflation should have fallen by enough to allow the Fed to ease aggressively. A recession that starts in 2023 while inflation is still above the Fed's target would prevent the Fed from acting quickly enough to minimise the damage to the economy. Let's turn to our asset class outlook. The gradual and uneven slowdown in the United States creates a complicated environment for financial markets. We're guided by our cycle, value, and sentiment investment decision-making framework. This makes us cautious on the 1 year ahead outlook for the US equity market. Valuation is expensive, and recession risks make the cycle a headwind. Our proprietary investor sentiment index is now slightly overbought after being oversold at the beginning of the year. Markets, however, could melt upwards over the next few months if investors begin to speculate, incorrectly in our view, that a recession might be avoided. Another complicating factor is the enthusiasm around artificial intelligence. Almost all of the gains in the S&P 500 this year have been delivered by a few stocks linked to artificial intelligence. This narrow leadership creates a risk that the gains could be quickly unwound if recession fears prick the AI hype. But it's also possible that artificial intelligence excitement offsets the cycle headwinds. On balance, we expect the cycle pressures to create downside risks for equity markets, but excitement about AI is an investment theme to watch closely. Our cycle, value and sentiment framework provides a positive outlook for US government bonds. 10-year yields near 3.8% are good value, Recession risk provides cycle support, and contrarian sentiment is supportive with futures data showing that most speculative investors are positioned for yields to rise further. Government bonds at current yields provide strong diversification protection for portfolios. Markets and economies have so far defied pessimistic predictions for 2023. This optimism might last for a few more months, but it's hard to see the US economy avoiding at least a mild recession sometime in 2024. It's important to remember that economies move in cycles and markets will eventually look ahead to predict the recovery. Thanks for watching, take care, and we'll talk again soon.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.